Hello and welcome to ET Now. My guest today is Rajeev Anand, MD and CEO of IndusInd Bank. Rajiv, thank you very much for joining us on ET Now. 11 months into the new role and resurrecting the entire bank, I would say, and getting it back to the same old growth which IndusInd used to have. How has been the journey to begin with?
I think as I came in 11 months ago, I think it was very clear that the outside-in perception of IndusInd was significantly weaker than what it was internally, meaning that the capital position was strong, the books were relatively clean at that point in time. We had some issues on the microfinance side, but other than that, nothing significant. Technology was pretty good, and people at large were fairly motivated at that point in time, and so therefore it was the platform that you got to build was fairly strong. And I think it was really to be able to reset ambitions, improve our processes and technologies, start to build a new team, and set the roadmap for the next 3 years was really what we did over the last 9 to 10 months. And I think some of that work is now beginning to show up in Q1, and what we've said is that 25-26 was really about repair. Now it is a reset and an inflection point is what we are calling Q1, because what we've also been saying is that 26-27 is when we go back to to market level growth and deliver a exit ROA of about 1%. And I think we are well on our way to be able to achieve those targets. And then once we get that done, it sets a great platform for us to aim even higher as we think about growth in some of our key sectors, being significantly faster than market, gain back market share in some of these entities, and then start to look at a ambition of a ROA of somewhere between 125 to 150 basis points.
Interesting. When you came in, one of the biggest work that you were trying to do is to recalibrate the balance sheet. Do you think the balance sheet is completely recalibrated for growth from here on?
By and large, yes. I think on the margin there will always be work that is happening in terms of rebalancing the balance sheet at various points in time. If you look at the corporate side of the book, I think going forward, some of the very large corporate businesses will grow slower. We will move towards more granular SME mid-corporate businesses on the retail. But overall, I think we're at about 35%. Currently, I would imagine that we'd be there and thereabouts. I do believe that the proportion of the SME piece, some of it is sitting in retail, some of it is sitting in wholesale, that will grow significantly faster as a composition within the balance sheet. And finally, of course, on the retail side, we do believe that we will now start to see strong growth on the microfinance side, a strong endowment of IndusInd Bank. Our commercial vehicle business, some parts of that you should certainly start growing faster than market, and some there is some work to be done, for example, on two-wheelers, etc. But I think the big growth will also come from the secured and the unsecured traditional retail asset businesses, which are still relatively small. You didn't see growth on that in Q1, but you did see disbursements going up. But that gives you confidence that those books, which is basically unsecured credit cards, personal loans, secured gold loans, home loans, affordable housing, business loans, etc., that piece should start to see growth from Q2 onwards.
So the provisioning which we have seen in the past, is it fully factored in now? Do we need to take more provisioning for some of the assets at this point in time, or is going to be a normal business kind of provisioning which will now henceforth be seen?
In fact, what you've seen is a significant improvement over the last 2 quarters in terms of both slippage, provisioning, and credit costs. And this is really a function of the improved processes, tighter underwriting, that we have put in place, and a significantly stronger collection mechanism that we put in place. As I look out, obviously one has to be a bit apprehensive, especially with all the issues in geopolitics and particularly in West Asia. But as we stand today, we do believe that, I mean, there is nothing to worry us, from early signs in any of our portfolios. So we do believe, notwithstanding some of the macro issues, we do believe that there is more to go as far as improvements in slippage and credit costs are concerned.
Is there a linkage of the balance sheet to the macro geopolitical risk which is there, which may come in at some point in time? Is there a surprise that may come in because how geopolitics is shaping up?
So it's an interesting question. I mean, I think, we've been worried about geopolitics really from, February onwards. But it hasn't, I mean, not just for us, but for the banking system at large, we have not seen any impact. But having said that, it does not mean that, second order impact, could not play out in the second half of the year. But it's a wait and watch.
If it's a second order impact, it would mostly come in mid corporates and SMEs, in your opinion?
Clearly, the large corporate businesses are, relatively deleveraged. They've got cash on balance sheet. They're much more resilient. Perhaps some pockets of the SME business, some pockets on the microfinance business, and we will have to wait and watch to see what happens to fuel prices and therefore the impact, on our vehicle finance businesses, for example. Given the fact that most of the lending is to fleet operators, etc., what we find is even if petrol prices do go up, it only means that freight rates will go up, with some lead lag. So I think there could be some demand implications, but from a credit perspective at this stage, we are very watchful, but nothing to worry about.
You call Q1 as an inflection point for IndusInd Bank. You give a brief idea of where you want to take the ROAs in the near term at the end of FY27. What will be the levers for that? Because currently, if I look at your ROAs, it's well below 1%, and if you add the tax write back, it's around 0.7. Otherwise, it's 0.65.
So I think we have to break that question into two parts. I think in the current year, much of that really will come from OPEX and from credit costs. Say broadly speaking, 60% coming from OPEX and credit costs, and OPEX efficiencies and credit costs, and 40% should come from the PPOP level. I think from a longer term perspective, that ratio will probably begin to flip. So the point I'm making is, in IndusInd Bank, we still continue to have strong operating leverage. I mean, I think if you look at the productivity that we are seeing from the branches, is relatively lower as compared to our peers. So therefore, there is a lot of work improving our branch productivity, improving through creating a new org structure, recreating the incentive structures and improving processes and within the branches through automation and AI. So therefore, things like that. There is a lot of work that's happening to improve the operating leverage within the system. So I think the brand is strong. The distribution is, we have approximately 3,000 odd branches. So the brand and distribution exists. It's really about how we can squeeze more out of the franchise.
If you look at the loan growth, overall loan growth is around 3%, but that's led by wholesale and corporate, which grew at 11% and 16% quarter on quarter. How do you look to grow that book? And you spoke briefly about SME and the retail book as well, where it's been very soft, flat for retail, and SME was a little soft for you. How do you plan to push those levers as well?
So I think there's always a little bit of lead lag. I mean, one should not look at these proportionalities on a quarterly basis. The point I was making was that both within the microfinance and the vehicle finance business, there's a bit of seasonality in Q1, which is really playing out. While I think as far as the retail is concerned, we've seen strong disbursal growth at 16%. That will start to show up in book growth. Really from some of it from Q2 and Q3. I think the retail piece is typically takes a little more time. It's much more granular as compared to the corporate side. But I think I do believe that all the engines for growth on the SME and the more traditional retail asset businesses are now well and truly in place. So I'm very confident that those engines will start to fire in the next 3 quarters.
Is it a deliberate decision to go slow on retail at this point in time? Because I'm trying to understand, because 50% of your retail is commercial vehicles. And CVs have done well in the last 2 to 3 quarters, the kind of sales we are seeing it. But for you, it has been flat quarter on quarter.
So there is, in fact, we are in that sense doubling down on the retail side. On the vehicle finance side, I was, explaining some seasonality, etc. I think we should be able to catch up in the coming quarters. Microfinance also we will see, growth from here, from here on. And like I said, the more traditional retail asset businesses, disbursements has started to grow. We should see book growth going forward. So there is no, to your question, is there an intent to slow growth? The answer is no.
Intent to consolidate and then grow.
The intent is to grow.
From a consumer banking point of view, how is that segment looking for you?
So the consumer banking really is both sides, the retail assets and the retail liability side. I think you've already seen that retail liabilities have grown reasonably strongly over the last 2 quarters. In fact, the LCR accretive retail plus SBC ratio at 49.5% is the highest that we have seen. And I think that's the momentum that we will want to carry forward, as we go along. We believe that one of the ways to strengthen the retail liability franchise is to offer more products, through the branches, personal loans, credit cards, business loans, SME loans, and so on and so forth. Traditionally, we have not done that. That is one engine which is now beginning to fire. And I do believe that as the retail asset business grows, as we serve our existing customers, we will see a positive rub-off on the liability side as well. It also has positive impact from a fee perspective. So today, as these disbursements begin to grow, it has a positive impact on fees, and therefore my ability to sell, other products, insurance, mutual funds, certainly improves. So those pieces, as the asset business begins to grow, will also start to kick in. And so therefore, I believe that there are 2 things. One is this synergistic relationship between retail assets and retail liabilities. And the other piece really is around building out what we call one IndusInd. We've got great relationships, great franchises on the corporate side, on our commercial vehicle business and our affluent business, and to some degree on the SME side as well. But traditionally, we have looked at many of these businesses as silos. We are now consolidating. For example, we now have a ED under ED retail, Jagdeep. This is the first time that in IndusInd Bank, the entire retail business, microfinance, commercial vehicles, retail assets, branches, and retail liabilities, affluent NRI sits under one head. That just by bringing that consolidation in place, we do believe that getting synergies from the various parts of the bank will only increase. And so therefore, there's a lot of effort, currently to be able to milk the existing franchise. On the corporate side, it's really what we call ecosystem banking, to be able to do more with our existing relationships. Traditionally, we have looked at it only from doing term loans or such like. But now we are also looking for salary accounts. We're also looking for cash management. We're also looking for trade finance businesses and so on and so forth. That multiplication will happen as we go along.
And how are you looking at the risk management as well? Because that was something which the street thought was a little weak prior to you joining, and you were trying to consolidate and put systems in place. How has that moved?
I think we've come a long way. I think we've come a long way, and I'm sure we've got a long way to go as well. But we've strengthened all the assurance functions. We have a new CRO. We have a new head of internal audit. we have a new CFO, we have a new compliance head, and I think while each of them brings their own domain capabilities, we've also got an integrated assurance forum as well, so that they are talking to each other. Nothing is falling between the between each of them, such that we are looking at risk on a more holistic manner. Is something that we are doing, and I think we've made significant progress there.
You've articulated a 3-year pathway to and for a growth which is going to be aggressive, and because it's an inflection, the growth seems to be like a J curve which will go up for you. Give us a sense of once in next 3 years, how do you see the mix between corporate and retail book for you? Because today corporate is much higher for you, and your focus now clearly seems to be now going after retail to get that going.
The focus really, I think if you look at the ratio, we're about 35% corporate, about 14-15% SME, and the rest is retail. By and large, this composition will remain, plus minus 5%, will remain more or less the same. But I think what we're really looking to do is to build a more predictable ROA tree, which means that the cyclicality through the cycle reduces, and the only way to do that is diversification across businesses, diversification across geographies, diversification across products, and get more and more granular to be able to mitigate risk. So, which is why the focus on building out an SME business, which is why we want to build out this product suite on the retail asset piece. And so, therefore, the burden to that extent of the PPOP being driven only by, in a sense, two engines, which is the vehicle finance business and the microfinance business, is reduced over the next 3 years. So then it becomes a much more predictable franchise, which should also give comfort to various stakeholders.